right, the topic of the panel today is the SCF market, bigger, better, or bubble, a very placative wording. So let's look into that. We'll look at a couple of topics we want to cover in this panel. Let's maybe first have a look at the figures. I had a check at the latest figures we have from the ICC Trade Register, and what is measured there, and I must admit it's only payables finance, not these impressive figures we have seen from Peter when he analyzed the factoring market, but also the numbers on the payables finance market are quite impressive. We have a very sustainable growth from $60 billion in 2017 to $128 billion in 2021, which is a very sustainable growth. There was a clear peak in 2020, then obviously COVID kicked in, but still, after all, over 5 years, over 4 years, the volume doubled in payables finance, which I believe is quite impressive nowadays. So let's look at these figures and talk about whether this is sustainable or not. We all know there were some recent prominent events in the industry. We talked about Greensill yesterday. Beginning of this year, we had the Americanas case in Brazil, which was also a very important event related to predominantly forfeiting, but it was also, there was also a connotation around supply chain finance. There are some regulatory changes which are relevant to the industry. We just mentioned FASB and IASB, respectively, US GAAP and IFRS. There is ESG, which had already been mentioned in earlier panels. And lastly, the general question of the role of banks and non-banks and how they can successfully cooperate with each other. I would like to introduce the panel now and would like to invite you to come forward and introduce yourself. Justin and John, Eric, do you want to? And then lastly, we have George, who unfortunately cannot join us in person today. But there you are. Thank you very much. Great for having you with us. Before we start, we would like to do a quick introduction. For those who don't know me, my name is Christian Hausherr. I'm working for Deutsche Bank Product Management, which is my bread and butter job. On a day-to-day basis, I'm also chairing the Global Supply Chain Finance Forum, which is a cross organizational industry think tank looking after the fostering and growth of supply chain finance. Let's start with the introduction of the panel members. Justin, if I can ask you to start and introduce yourself.
Thank you. Happy to be here today and share some insights from FinTech perspective on the panel. So I'm Justin, credit risk leader at Beacon. We are a FinTech really aimed at disruption in international trade in particular. But really getting the tools that businesses need, as SMEs in particular, getting those tools to them. So one is certainly visibility over supply chains, which I think we'll touch on a few times here today as an important tool for both businesses and lenders in terms of risk management. And the other part is a financing angle, which we help to finance businesses in the international trade.
Thank you very much. John, do you want to continue?
Yes. I'm John Amorti, and I work for Bank of China London branch, and I cover the development of supply chain finance for the bank.
Thank you. Eric?
My name is Eric Balmer. I am the CEO of Global Supply Chain Finance Group, which is a company established since 32 years now in this market. Basically focused on servicing large account receivable programs or large factorings globally. The company has been purchased 2 years ago by Blackstone Equity, private equity. We are based in Zug, Switzerland, a very nice place. And basically, we are a proprietary platform. We developed our applications by ourselves, and we are servicing large banks in the industry that we've seen today. And yesterday, and we are keen to support the growth of this business over the next decades.
Thank you. Lastly, last but not least, George, can you please shortly introduce yourself? Thank you.
Hello, everyone. It's my great pleasure to be a part of this panel discussion, and my apologies that I had to join remotely. I am a business development director for factoring and supply chain finance solution at Qualco Technology. Qualco is a technology provider for factoring and supply chain finance. I have around 25 years of experience in the banking industry with major specialization, trade and supply chain finance. And in the past, I have worked for various multinational banks in Europe and the Middle East.
Thank you very much. All right, then let's dive directly into the matter. Let's start with the first point we would like to cover. The current demand and growth of supply chain finance, and the numbers we have seen are actually quite impressive. The numbers we have seen from Peter, and also we can see in the trade register. There is definitely growth, which is good. The question is this sustainable? Or should we be concerned that this is not sustainable and may go away? Eric, what do you think? You want to start?
Sure, thanks, Christian. Yeah, I would also say yes, this is sustainable. Mm-hmm. We've seen over the last years and even recently many new players coming to the market beside banks. We call them non-banks, very diverse type of funders, large institutions, large funds, sovereign funds even, or asset managers. And why? Because they've seen that this business is linked to real economy. It's a safe haven. Doesn't provide high returns, but decent returns. Yeah, I think they've seen it and are really keen to find this type of asset class. Also to diversify from the traditional asset class that have been involved in the fixed income asset. However, I think we need to make sure that we deliver an excellent service and hopefully not too many defaults, because once the markets will evolve back with more predictability, good returns in the other asset classes, we may face some kind of move away from this supply chain by these investors. So we need to capture them and make sure that they are comfortable in this industry and continue to help us to develop that.
Yeah, that's indeed true. No, thank you very much. Justin, do you want to also comment on this question of whether the growth is sustainable or not?
Yeah, I think I see certainly the market is quite early in its demand cycle, really. Think about the scale of international trade and international trade finance. This is still a relatively small amount. And it really is in some ways, I guess, a play on globalization. We have a lot of international trade, and the more that continues and the longer supply chains get, the more complex they get, the more it feeds into certainly a need for additional financing along that spectrum. And supply chain finance is really, and it's probably something I'll touch on a few times here, but I see it as a almost unique tool where you have a financing product so closely tied to visibility over supply chains, which feeds into obviously risk, feeds into ESG measures. You can have greater visibility, and that's something that's either here or coming very, very soon. So it's I think it'll be a product where it sees a lot of growth.
Yeah, great. Thank you very much. I don't know, George or John?
From my perspective, I think there would be further growth in supply chain market. Mm. However, the rate of growth could diminish with time. Judging from last year and this year, in addition to the FCI and also the trade register, there's also the report from BCR as well, which saw a 20% increase in world global supply chain finance up to about 2.1 trillion. And then you've seen, if you look at the various regions across the world, we've seen increase in most of the regions. Starting from Africa, for instance, which had about a 39% increase compared to last year. And you also have that of Asia, about 28% increase compared to last year. You also have in America, 21%, and Europe, about 18%. So we've seen steady growth. I think the growth will continue. However, it might not be at that trajectory. So I think there could potentially be a diminishing return at some point. But for now, let's enjoy what supply chain has to offer us.
Yeah, okay, great. Thank you. George, any thoughts from you?
Yes, I agree with the gents. Definitely there is a growing demand for supply chain finance services, especially in the developing countries. As John very well mentioned, in Africa and Middle East, there is a very high demand, and the last few years we see some, let's say, imbalance between the demand and the supply of supply chain finance specific regions.
Okay, thank you. Oh, that's good. So we seem to be on the right track. There is growth, which is good. And we also heard that from Marc Aubon yesterday. Generally, growth is good. Globalization is good because it creates value and welfare. The question we want to discuss on this panel is also, do all parties, or do parties generally, have lending restraints, or is there a risk of a bubble? And, well, as you can imagine, I'm a friend of terminology, and first thing I did was I want to be sure that we have a joint understanding of what is a bubble. So I looked it up, and the definition of a bubble basically is an economic cycle that is characterized by the rapid escalation of market value, particularly in the price of assets. This fast inflation is followed by a quick decrease in value or a contradiction that is sometimes referred to as a crash or a bubble burst. Usually, the price of assets is brought in connection with, for example, housing prices, which is not the case in supply chain finance. So translated into supply chain finance, I would say, okay, is there so much supply chain finance exposure in the market that there is a risk of a substantial wind down? Which is the question I believe we have to answer in this panel. So I'd like to ask you guys, Eric, do you want to start? What do you think? Do we have a bubble or not?
No. I would say no, not yet, hopefully. I think, yes, we see growing business, so growing demand of this kind of asset class we just discussed. That's good. Everyone should benefit from that. At the same time, you should make sure that it's not becoming a borrower market, meaning that the borrower are dictating the conditional terms, which is never good in the finance industry. We always have to balance between the lending and respectively the borrowing aspect. Because if that happens, that then the margins will go down, there will be more competition, while the risk remains the same. So it doesn't matter, the risk is on the borrower side. And that may lead to some defaults. And if that happens, then these, especially new lenders, we were just mentioning earlier, may be a bit afraid and may escape this market. So that would not be good for us collectively and could even lead then to a kind of bubble. So hopefully not.
Yeah, okay, great. Any further views from anyone you would like to share?
Yeah, I mean, from my perspective, yeah, I agree. I probably wouldn't say a bubble, but I definitely think there is some froth. It's one of those markets which is characterized by a great degree of concentration in larger, higher grade kind of businesses as kind of borrowers. And, you know, there's, I think the flow of money, it's a little bit too much for that kind of, that sort of space. And we end up seeing some mispricing at times, the risk involved. And I think a key part to keep growing, this SCF business to keep growing without risk of a bubble, is certainly to broaden the borrower base and to look further down credit curve a little bit, certainly to smaller businesses. Not necessarily, I mean, it's difficult, high cost to serve to get down to the very smallest, but there's definitely scope to, I think, spread the application of the product to a wider range of businesses, which will, you know, ensure the growth without the bubble.
Yeah, I would agree to that. I mean, in fact, there is still this infamous long tail which is not served by supply chain finance, and I believe there are still a lot of companies who have not even started with supply chain finance. Yeah, corporates in the middle segment, also large corporates. So I would agree. Yeah, indeed. John or George, what are your thoughts? Do we have a bubble or not?
From my perspective, I don't think so.
Yeah.
There's so much untapped markets out there. Like I said previously, emerging markets, Africa just has about roughly that 2% of the total supply chain finance
Exactly,
opportunities
yeah.
globally. So there's
Yeah.
so much opportunity
Yeah.
there to tap into that market. So I don't see it happening any foreseeable future, to be honest.
Yeah.
I think it's going
Yeah.
to grow, and it's just a matter of us thinking of more dynamic ways of doing business within supply chain finance ecosystem. But I don't see the risk of a bubble.
Yeah, yeah, I agree. And indeed, there are also all the emerging markets, yeah, where the global supply chain finance techniques are not yet that common, yeah. But there's much of room to grow. Yeah. George, what do you think? Bubble?
Yes,
or not?
I would agree also that at least now there is no bubble, and I cannot predict that there would be a bubble in the future. These programs have been running successfully for over 15 years and more. And while focused on a specific segment of credit, I don't think they are going to bring huge issues. Of course, we had the problems of Green Seal and Americana that you mentioned before, but I believe in general these are successful programs, and the demand is continuing growing.
Okay, thank you. Well, very good. Thank you very much. Now, let's look at the next topic. And the question basically is, are there any regulatory or other changes on the horizon? And what is the likely impact? And many regulatory changes had already been mentioned, or I guess most of you are aware. Let me just mention we have the recently published reporting requirements under US GAAP, which have been published by FASB and which are effective this year for the first time, started January 23. So we can expect audit firms or companies to reach out to providers beginning of next year when the annual report is going to be prepared. There's IASB or the IFRS reporting requirements, but which are still work in progress, as I understand. There's the URDTT, which talks about digitalization. Yesterday we talked about the MILITER, or the model law on transferable assets, which in my understanding is still work in progress with the UK Parliament here in the UK. We have the whole discussion around ESG, which is not so much regulation. I mean, there are regulations, like the EU taxonomy or the Greenhouse Gas Protocol, or Supply Chain Finance Act, which have been implemented in some industry or other industry frameworks, like the ICC. So there's a lot of regulation out there on ESG, and I actually wonder, and maybe we can talk about that, what is the impact or what are the ramifications of all these incoming regulations for the SCF industry? So it's a wide array of topics, and we don't need to dive into each and every one. So let's maybe start with you, John. So what are your thoughts? What is the most pressing topic which keeps you awake at night?
Maybe my mortgage. I'm sure it's not ESG or exactly. We're together, right? Fantastic.
Have you forfeited it?
Yeah, that's a good point, though. Anyway, so in terms of regulatory changes, I think a lot has been dealt with it already, to be honest. So not to flog it, but I think the introduction of MILITER, I think the model law, the UK model law for transferable records, I think it will be a game changer. Over the years, there's been so much talk on digitization, but you keep looking at the stats. How much in terms of bill or lading is being done electronically? Less than 1%. It's really an appalling statistics. But I do think that with the introduction of the UK model law for electronic bill of lading or electronic documents, it will give the same rights as digital documents, as paper documents. I think it will go a long way to start getting more the use of electronic documents to be accepted as a legal document. with UK adopting, I think I'm going to be adopted sometime in June this next month, with the passing of the bill at the Parliament. Once that is done, I think it will go a long way. With that, you could have shippers transmitting documents through some platform to the various suppliers. Suppliers could use the same document, could bill of lading, bill of exchange, transmit through their own, maybe a banking system to the banks. The bank could, from Oswell, transmit it to the various counterparties, even down to the buyer, through a platform, a bank platform or some means. It will save so much time, so much efficiency will be into the process. Once it's done properly, I think it will be a game changer from that perspective.
Yeah, that's good to hear. Okay. Any other views? Or?
On the, you also mentioned the ISB. I think there's been a lot of and there's discussion about fraud and so much going on in the past. In the past years, you had cases of the Carillion, the Bengoa, NMC, Green Seal, a few of them. I think it had led the rating agencies and investors to begin to push for more transparency. I know there's been push for, say, okay, changing the asset base from trade payables to bank loans, to bank debts, which we pushed against. But I really do think that there's no harm in providing more transparent information on people's financial statements. I think what they've been looking at which is being passed already by the FASB, Financial Accounting Standard Board of the US, and I think they've been pushing for more qualitative and more quantitative disclosures on financials, or in terms of what exactly, to what extent are some of your finances, or leverage ratios, or is being supported by some financing arrangements. There's no harm in disclosing some of this information. They want some more information in terms of your supply chain, the days of supply chain finance, or the amount, and a few other information. I've seen an increase in requests coming in recently already into the bank asking us to provide some more information to that effect. So it's coming on, but I don't think that will stop people from still using that same product. So nothing wrong in disclosure. Most banking is done rightly, and the information is correct, and people are aware, so that investors, rating agencies can make the right information from a credit standpoint.
Yeah, indeed. And I read a recent report from Demica where they interviewed corporates, and most of the corporates, interestingly, weren't too worried about these new reporting requirements. What I'm asking myself is whether the still outstanding decision of the IFRS on the reporting requirement will have any repercussion effects on the rest of the reporting universe, which is something we don't know. We don't even know how the IFRS is going to decide whether they want to, whether they ask corporates to report unfinanced payments or not. If they should stick to that approach, I'm really curious on how this is going to be handled from an accounting perspective. Currently, it's only a reporting decision or discussion. But we don't know. We don't know what's going to come out of that. So I don't know, Eric or Justin or George, any views from yours? Yeah, yes, please. Yeah.
Just to complete what John just said, I think I fully agree that we need to make sure that the regulation is not, let's say, deteriorating the industry. So we need to keep it as simple as possible. But at the same time, I think regulation is also helping to enhance credibility for us collectively in the community, in industry, because we just said the new players are coming. So for them, we are kind of a new asset class. So the more we can set the bar in a way that they say, yes, this industry knows what they do. They have been there many, many decades. They have some regulations which are waterproofed. That will help us collectively to keep them and maybe even more attract additional new players into this industry. So it's a balance between that and, of course, we need to make our homeworks.
Yeah. The other challenge will be the actual implementation of all these requirements. And the provider side, and I believe also on the auditor side. I mean, when I look at global corporates, they often use programs with a number of suppliers, vendors, and I'm just imagining stepping in the shoes of the auditor. They will have to put all this information together, which may be a challenge on its own. Yeah, and they will also not only have to receive and consume this information. If I'm a serious auditor, I would expect that I would also have to validate in my client's ERP system whether the information I have received complies with what I see in the ERP, which is an extra loop. And if it doesn't comply, I will have to go back to the vendor and ask them, well, why is there a difference? Can we please discuss? Yeah? Which can be a very painful process, but we will see. Yeah? Any other views from George or?
Yeah. I'm happy to maybe offer a slightly different perspective on electronic documents in particular. I think we've seen something that offers really great promise here, but when I think back about, we had a similar kind of path with blockchain technologies being introduced. When I look around and think even, I do a lot of work at medium, smaller business end of scale. Open banking is meant to open a lot of things as well, and we still see a lot of reluctance from clients to open their bankings or open their accounting packages to lenders. But I think we need to be conscious that there is a constraint about cost to serve and about trust issues. And in a world where even our personal cards are hacked on a kind of regular basis, it's very difficult to actually go from the dream of electronic documents through to the implementation. It's not an easy step, especially for smaller businesses, but even large businesses, I think, will be very cautious about necessarily opening a lot of steps to their ERPs. So I think this is definitely an education process needs to happen before we can really make full use of the technologies available.
Fully agree, yeah. Okay, great. Thank you very much. Well, let's maybe, in the interest of time, time is moving forward. We've got 15 minutes left. Well, let's maybe have a very quick look into supply chain finance as a driver for social good. Is that the future of the sustainable business? What is your view? Is this sustainable? This sustainable business? Is it the future? Is it relevant or not?
I'm happy to kick off.
Yeah.
Probably have touched on similar points already, but in my views, supply chain finance has a unique position as a financing product to be an impact investing tool because you have that visibility over supply chains. We're talking about electronic documents. All these things feed into a very similar thing about having visibility of origins, where things go, what ships they're on. And I think it offers a great tool to, not just risk management, of course, but it offers a great tool to look at ESG ratings as in particular. Yep. Relative to other financing products, it's certainly a standout to me. I don't think you can look at many other products and see the same advantages we would have in supply chain finance. And I think you'll find some investment flow follow that. At the moment, I think the driver really is from funds down to lenders, and lenders hopefully eventually to borrowers. But I think we're approaching a day where regulation will become part of this. We've seen supply chain finance itself go from no need for disclosure through to obviously increased levels of disclosure. And it's a natural progress I think we'll see here as well. And the more the industry itself gets behind this and actually promotes the use of supply chain finance to integrate with ESG goals, I think it'll be important.
Yeah, thank you. In the interest of time, and since sustainability was already discussed yesterday, let's maybe move forward to the next topic and look into how significant is the trend for banks and fintechs to collaborate rather than compete, which is a question I believe I have already participated in a number of panels on this. It's an endless discussion. So let's, George, maybe we start with you this time. So what is your view? Is it cooperation, competition? Let's hear. What do you think?
Yes, if we look back to some decades ago, the providers of supply chain finance were the large multinational banks, which initially use old-fashioned and manual processes to manage the demanding programs. And also there were many banks, especially mid and smaller size, that didn't have a platform at all, or they had the kind of mono-product platform used for the traditional reverse factoring. So what was missing, obviously, digitalization. And this is how the fintechs started getting into the picture. So they identified this imbalance and tried to resolve it with their digital solution and techniques. So it covers origination, supplier onboarding, financing, etc., etc. And when the fintech scene was just getting started, definitely there were certain startups that proclaiming that they were a part of a kind of revolution and that traditional banks were not sufficient enough in order to support this kind of supply chain finance programs due to lack of digitalization and technology. So, of course, there were banks that didn't want to partner initially with the fintechs, and also fintechs that did not want to partner with banks. However, it was proved that sharing the pie is safer than the approach of the winner takes it all. So I feel there is a room for everyone in the supply chain finance space, and definitely cooperation makes a lot of sense. And it is very important and great when every party does what they are best at. So it seems that relations between fintechs and banks is getting more and more mature nowadays.
Very well said. Thank you very much, George. And I fully agree. Every partner needs to find its field of core competency, and then those fields where partners can successfully cooperate, they should cooperate. Eric, what is your view?
So I think banks, fintechs, I think it's a marriage which is going well, which should improve in the future. I believe will improve further in next years or even months. There are banks who would like to become fintechs. There may be fintechs who like to become banks. Why not? At the same time, I think these are very different businesses. I think the banks should focus on what they do well, meaning risk assessment, risk-taking, funding, liquidity, global coverage with clients. That's what they do very well, and they should continue to do, hopefully, long time. The fintechs have the energy to be flexible. They offer agility. They offer innovation. They offer R&D that all the banks can do, pretend to do, but if you're honest, I'm not really doing. And just an example, I was in the bank industry more than 20 years ago before I joined fintech. I was running the financing products for the bank. When I wanted to invest into the platform, it's factoring platform, for example, for $1 investments, I could invest 80 cents for run the bank just to maintain the system running, and 20 cents to develop, change the bank. Can you imagine? How can you develop something for the future? It's not possible. Yeah. You just maintain and then you a little bit develop. So I'm a strong believer that there is room for everyone, and each one should concentrate on what they do well and complementary offer the best services to the clients at the end of the day.
That makes a lot of sense. Thank you very much. We've got 10 minutes left, and I would like to move to the, not the last topic, but the next one, and which is about how are fintechs analyzing risk for SMEs as buyers, and what are your predictions for innovative supply chain finance solution in terms of deep tier financing, pre-shipment financing, or supplying the long tail. George, would you like to start on this question? Yes, please.
Qualc was a platform provider, understands properly the need for proper risk assessment, and such tool to the banks that are using our system. And also we are helping them to create a kind of modeling. They would like to measure that risk. Obviously ourselves we are not assessing the risk because they are software provider. However, we realize that over the time it is a necessity to build tools that enable measuring risk and making more precise the assessment, the risk assessment. I believe as an ex-banker that in principle the risk categories themselves have not changed significantly, and SMEs are still vulnerable in securing funding or become accepted to supply chain finance programs, especially as buyers. And this is based mainly in a kind of information asymmetry between the SMEs and the banks, and also the fact that the due diligence and credit assessment for this segment requires higher cost and time, of course. And this is a very serious bottleneck. However, fintechs are, let's say, uniquely positioned to fill the gaps because using the technology allows them to successfully, let's say, evaluate the risk by, let's say, analyzing the unique risk profile of each client, of each company, rather than using a model of one size fits all. So I think using the technology and specific tools like artificial intelligence and big data analytics help them to predict the transactional behavior and analyze the transactional behavior. For example, there are companies that get data from insurance companies and they are in position to analyze better the patterns of payment, credit notes, and other very important elements for the due diligence.
Okay, great. Thank you very much, George. Justin, what are your thoughts?
Yeah, obviously from a fintech background and being a credit risk person myself, this is a core part of what we do, but fundamentally risk dynamics, risk decisioning is the same, hasn't been reinvented. Key parts that have been reinvented are data availability. So data connections with businesses are much easier these days. I know I already touched sometimes on the difficulty getting a lot of customers to on board with open banking or open accounting, so you can have the full integration to their ERP. But it is happening, and it will over time become commonplace. It's, open banking is increasingly commonplace, and open accounting will be next. There's a lot of other data sources to draw on, and that helps you close that information gap that exists for all risk decision makers, frankly. Second part really is where we have done a lot of work, which is in extracting more information from customers in a cost-effective way. And cost to serve really is a key part of key barrier, I guess, to credit analysis, because fine, if you're dealing with large companies, you can spend some time, but if you're dealing with a lot smaller companies, you need to move much more quickly. And we have a lot of smart questioning that can kind of read the data and I guess come up with more key questions to ask. And I think this is a place where AI is absolutely going to be a game changer. That if clients can interact with a chatbot or something it's a little bit cold, but a version thereof to exchange information and for a chatbot to extract the right kind of pieces and feed that into a credit process, that's something that's not being done right now, and again, filling that information gap. And the third is really supply chain visibility, and there's many tools. Beacon's building one or has one. Many other businesses are building supply chain visibility tools, and that is where I think we get down to deep tier financing. It's been a subject I know for a very long time. I don't actually have hope it's going to arrive tomorrow, but I do actually, with the tools we have, do have hope it will arrive at some point soon. And I think they're the three kind of key pillars we need to be hitting.
Great, thank you very much. Let's come to the last question, which is my joker, and we decided on that yesterday. We talked about generations yesterday and the future of education. And based on that, we thought, well, what is, and closing the loop to the sustainable growth of supply chain finance business, we have obviously seen from the figures, what are the expectations from future corporates when we look at future generations? Recall these generation discussions started with Generation X, then we had Generation Y and Z, and we were just discussing, okay, what is the name of the next generation? And I thought, well, maybe we are now moving to the Greek alphabet and the next generation is Generation Alpha or something, which would leave us 26 letters to be left, and then we can take a new decision what it's going to be. So the question is, what will be the expectations of the founders and entrepreneurs and CEOs of Generation Alpha in terms of corporate finance? Will they still ask for supply chain finance? Will they activate their AI tool and see what's on the market? What do you think? Is that a challenge to supply chain finance, or rather an opportunity? What are your views? I'm really curious now.
Well, personally, I would think the use of AI or generation AI, generation alpha will enhance supply chain finance. Because you can't do away without a product. You still need some form of enhancement using of technology to enhance the system itself, the product itself. So you can't do away without supply chain finance, it will grow. I think it will create enhancement on, and in case of doing credit analysis on some of the debtors or some of the counterparties, it creates more efficiency. We have some programs where you see hundreds of debtors, and how do you go around that? I listened to someone talking earlier on today, talks about having hundreds of debtors, and AI has gone a long way to be able to analyze some of the financials, come up with very accurate information as regards their financial statements. So I think that generation will depend more on AI, but I think it will need to create more enhancement into supply chain finance.
Great, thank you. Eric, you...
Thank you for this question. I think, yes, it's a very deep debate yesterday. Nobody knows, but we know that they will have different expectations. And from that perspective, I think collectively, banks, fintechs, we should think in their shoes as a client, as you say, an entrepreneur, a CFO, a CEO of tomorrow, after tomorrow. We have too much a tendency to think from our perspective, what are the solutions for tomorrow, which is good, which is normal, but we should never lose this perspective from the client, and especially expecting the new generation, alpha or beta or gamma, let's see where we will end. But to answer something, I think optionality. That's what they will ask and expect from us, correct? Optionality, I would say. I'm not a visionary, but that would be my expectation.
Yeah. Well, as we said yesterday, never make predictions.
No.
And if you do, don't write it down. Yeah, exactly. We are at the top of the hour, and I would like to close this panel. And thank you very much, George, Eric, John, Justin, for being here and sharing your thoughts. Thanks for listening to us. It was a great panel. Thank you.
Thank you all.